the next point which we want to understand in international finance is the practical application of trade. So remember, we had our earlier sessions talking about the introduction, the importance and the different theories of international trade. Now we will be trying to understand what is the application of this international trade in country. The heading or the punchline, it is called BOP, that is balance of payment. What does that mean? We'll just come to it in detail. So before that, from this session we are trying to understand, we want to have these three learning outcomes. First one, we should be clear on the meaning of it. What do you mean by balance of payment? Second one, okay, I understood the meaning. What does this combined of? What is this concluded of? It talks about the components of balance of payment. Third, now what is its importance for me as a student, as an individual, as a taxpayer, as a citizen? So all levels, that is the importance, and anywhere there is no theory without limitation. So we also will be concluding with the limitation of BOP. Coming to the first point, what is BOP? BOP, I have already told you, balance of payment. I am sure you would have studied the balance sheet. What is balance sheet? It is a sheet which balances on a particular date. And balance sheet, who does it? Okay, who does it means chartered accountant does it. For whom? For companies or corporates or HUFs or partnerships, whoever it is, who they want to disclose their final accounts. So same way, BOP or balance of payment is a country's balance sheet. Remember, all people, individuals, companies, corporates, HUFs, partnerships have their own balance sheet. Same way, country also has a balance sheet. So country's balance sheet on a particular date is called balance of payment. Again, what does it do? Just like our balance sheet, here also the transactions are recorded. Again, please remember, transactions means financial transactions. But who are the parties? It is between one country and rest of the world, which means there is no one-to-one. India might be having trade with China, India might trade with Bangladesh, India might trade with UK, India might trade with Europe, India might trade with Sri Lanka, anyone. All trade will be accounted in one statement for India, that is India's BOP, balance of payment. What is the tenure? The tenure is normally for a period of 1 year, which means our ordinary balance sheet and country's balance sheet tenure remains the same. What do you mean by BOT? BOT means balance of trade. Balance of trade means it is a statement which records transactions of goods traded, as simple as that. So only goods will be recorded in that statement. Now, what is the importance of BOP? BOP is an indicator of economic growth. What does that mean? It tells you what is your economy. It tells you how good is your economy. In fact, I am sure you might be reading the newspapers. Even last 2 days I was just going through the newspapers. There is a statement that India's projected GDP of 7.5% is going to be real or is reality. What does that talk about? India will be growing at 7.5% per annum, which is very good number. How are they able to understand it? They are able to understand it by looking at the history, by looking at the forecasted data. What are they doing? They are having one of the prime indicator as BOP. Again, there is one more line in the newspaper. I am referring to Economic Times. I am sure all newspapers would have that. They are talking about India will be able to control its physical deficit by 3.5%. So what is that deficit? It is again coming from balance of payment. So that is why it is written balance of payment is an indicator of economic growth. So you can have positive balance of payment and negative balance of payment. When it is negative, it is called deficit. When it is positive, it is called surplus. When you will have positive BOP, when your outflow is less than inflow. What do you mean by outflow? When you import, you have to pay money. That is outflow. You are giving your money. What is inflow? When you export, you will get money from the other country. So your import is greater than export. You will have more outflow than inflow. In such a case, your BOP is positive. Automatically, what does that say? You are able to attract more foreign investments. BOP is negative when your outflow is greater than inflow. So outflow means the money you pay out, inflow means the money that you get in. I repeat, outflow means the money you pay out and the inflow means the money you get in. So BOP is positive when the money you get in is more than the money you pay out, or the money you pay out is less than the money you get it. BOP is negative when the outflow or the money you pay out is greater than the money you get it. What is the concept? How is it understood? How is it written? It is a summary or a statement of international transactions. What does it have? It have, as usual, a debit and a credit side. Remember your balance sheet? You had assets and liabilities. What do you mean by assets? The investment or the fixed assets you have in your organization is asset, including human capital. What is your liability? The amount you have to pay, or the fund you have to give, or the loan you have to repay. All outside, which you have to give back. Same way, you remember profit and loss account? There is a debit side and a credit side. Here also, in BOP, there is a debit side and a credit side. What does this debit side talk about? Debit side talks about the inflow of capital. Just remember, profit and loss account, debit side talks about the expense. So this is exactly the reverse of P&L, which means the opposite of P&L. So here debit side means you will get inflow, what is coming to your country will be debited, what is going outside your country will be credited. Ideally, this is your double entry model. Ideally or practically or technically, both sides, debit and credit, should tally. But in reality, this is not sure, or this is not. We will tell you why. Coming to, now you might be telling, okay, I understood what is BOP. It is a statement recording international transactions. Now what does this BOP contain? It contains a summary of financial transactions. When is it prepared? It is prepared during 1 year, or normally during a period of 1 year. What does it have? It has debit and credit sides. And BOP can be positive or negative. It has to be balanced. Till now we have covered this. Now, coming to what does this BOP contain? I understood the skeleton, but tell me the flesh. What is inside BOP? The answer is here. It contains, as per IMF guidelines. What is this IMF? It is International Monetary Fund. It is the biggest team in global financial management, which means I'll tell you the history of IMF also in the subsequent sessions. So IMF has clearly given the guidelines as to how a BOP should be prepared, which means there are normally 2 accounts or 2 plus 1 small sub account. So the accounts names are, one is called current account, another one is called capital and financial account, and the junior sub junior account, which means these are the main 2, followed by one more, that is official reserves account. So repeating the same line, BOP has 3 parts. Of that, 2 parts are very important. The first part is current account, the second part is capital and financial account, followed by official reserves account. What does this current account contain? Current account has the receipts and payments related to, please remember this is the keyword, import and goods of services, import and export of goods and services. So what is your goods you are importing, that will be recorded. How much goods you are exporting, all financial transactions, not kg or quintal or liters. We are not bothered about volume. We are bothered about financial exposure. Remember that very carefully. We will record only financial transactions. Normally, when you are having a trade, there will be finance either inflow or outflow. That is recorded here. So in current account, you will record all goods and services, payment and receipt. Again, current account is further subdivided into three parts. They are, first one is goods and services account, second one is primary income account, third one is secondary income account. So goods and services account, blindly it is talking about that. Primary income is what you are trading from, and secondary income is the next half of it. We will go to it. What is this goods and services account? Goods and services account is, all the name suggests, it is really recording the goods and services that are either exported or imported. Which means the account will have both exports and imports. In my case, if I am exporting, automatically I will record, and if I am importing one good, that also will be recorded. It is not one side, it is two sides, because we have a debit side and a credit side. Both has to tally actually. Second, goods and services, even though the name is written in one line, they are shown separately. So goods means, what do you mean by, what is the difference between these goods and services? You know the difference between buying a flat and taking a car for rent? You know it? That is the answer. Buying a flat, what are you doing? You are getting the ownership of it. So that is your good or your asset. You are taking a taxi for going to airport. What is that? That is a service. It is not your car. You are paying the rent or the taxi charge for using it till airport. So once you get down in the airport, that is not yours. Even when you are traveling, that is not yours. But since you are paying, you are given the right to travel. As simple as that. So goods account, in which the ownership is transferred. Services account, the ownership doesn't arise because you are just paying for the service. And what you remember, BOT, which we have mentioned, that is nothing but the difference between export of goods and services minus import of goods and services. If export is more than import, you are having balance of trade positive. If export is less than import, you are having balance of trade negative. Next, primary income account. What is this primary income account? Primary income account is nothing but it talks about the current account. Automatically it is a part of current account and records the income received, please remember, and the income payable to non-residents. That is primary. So in this account, the entry will be purely of non-residents. So non-residents, what is the income received and what is the income or the expenditure paid, which will be recorded in the primary income. Here, this is the reason which will affect our GDP. So when we are talking about Make in India campaign or when we are talking about Digital India initiative, we are all trying to attract foreign investments. We are all trying to ask our own citizens who are employed or staying in US or UK to come and invest here or invest their money here. The answer is this primary account will capture that figure, and that is closely related to gross domestic product. Gross domestic product is closely related to the economic growth. So that is why so-called our Prime Minister is traveling almost all places, because once that is clear, our India's economy will revive very fast.